Hey everyone, welcome back to Corporate Decoder. We're diving into Grindr Incorporated's latest SEC filing today, and let's just say things are getting a little more connected financially speaking. Before we jump in, if you like getting the real story behind corporate moves, make sure you hit that subscribe button, and if you want to chat about this stuff with other finance fans, join our Discord, linked in the description below. Alright, so Grindr Incorporated, the company behind that popular dating app, has filed a Form 8K. This is pretty much an everything you need to know right now report for big events. And the biggest event here is a pretty significant update to their borrowing power. Here is the story. Grindr Inc. has modified its existing credit agreement. Think of a credit agreement like a company's main borrowing contract. They've amended this agreement, and the key takeaway is a big increase in the money they can borrow. Their old term loan, which is like a big one-time loan for specific projects or needs, was for $300 million. Now, get this, they boosted that up to $400 million. That is an extra $100 million in borrowing capacity for longer term needs. But that is not all. They've also supercharged their revolving credit facility. This is more like a credit card for a business where they can borrow, pay back, and borrow again up to a certain limit. This facility has gone from a modest $50 million all the way up to a whopping $200 million. That is a fourfold increase, meaning they have a lot more flexibility to manage their day-to-day cash needs. They also bumped up the sublimit for letters of credit, which are like guarantees for transactions, from $15 million to $45 million. And to top it off, they've also pushed back when these loans are due. The old loans were set to be repaid by late 2028. Now, they've extended that deadline all the way to the 1st of January 2031. This gives them a lot more breathing room and time to use this new funding. Now, how does the repayment structure work for this bigger term loan? Well, it is going to be paid down gradually every 3 months. Starting in March of 2026, they'll be paying back 1.25% of the borrowed amount each quarter. Think of it like making steady monthly payments on a mortgage, but just 4 times a year. So what are they going to do with all this extra money? The report says the funds, both from the increased term loan and any future borrowings on the revolving credit line, can be used for working capital and general company stuff. This includes buying other companies, which is often referred to as permitted acquisitions. Basically, they've got a lot more financial firepower for whatever strategic moves they want to make. And here is a key detail. On the very same day this amendment was signed, Grindr Capital LLC, which is a subsidiary of Grindr Inc., and the actual borrower took out the full amount of that increased term loan. A good chunk of that money went straight to paying off what they already owed under the old agreement, and the rest covered fees and other costs associated with setting all this up. Now, looking at this from a business perspective, this move tells us a few things. First, it shows that Grindr Inc. has secured the trust of its lenders, like JP Morgan Chase Bank, to take on significantly more debt. This often happens when lenders believe a company has a solid plan and can generate enough future earnings to repay these larger sums. Second, this increased borrowing capacity suggests Grindr is planning for growth, or at least wants to be prepared for opportunities, whether that is expanding their existing services, developing new features, or potentially acquiring other businesses in the dating app space. They now have the financial flexibility to do so. The extended maturity dates also signal a long-term outlook. However, it is also important to remember that taking on more debt increases a company's financial risk. If Grindr's business doesn't perform as expected, servicing this larger debt load could become a strain. It is a double-edged sword, more money for growth, but also more to repay. Especially in potentially challenging economic times, compared to other companies in the tech and social media space, Grindr operates in a niche but highly engaged market. Their ability to monetize their user base through premium subscriptions and advertising will be crucial in supporting this increased debt. We'll have to watch their future financial reports to see how this new funding is deployed and what impact it has on their profitability and cash flow. In conclusion, Grindr Inc. has significantly strengthened its borrowing capabilities, signaled a commitment to future growth, and extended its repayment timelines. It is a strategic move that positions them for potential expansion, but also comes with increased financial obligations. Alright, that is our breakdown of Grindr's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.